Hi everyone, Donna here. I want to talk to you a little bit about the number one reason people hire a bookkeeper. The number one question that I get asked every day. Before I get started though, if you appreciate the information that I'm giving out on these videos, and if you find any value in them, or if you have any comments, questions, concerns, or if you want to hire me, please comment below or send me a direct message. I would love to hear from you. I'm really interested to know what the feedback is on these. The number one question I get asked this every day. Where am I at? How's my business doing? Am I winning or losing? Is my business healthy? And they're all really the same question. So as an accountant, I'm going to look at 3 different reports to see how a business is doing. Venture capitalists are going to use these reports. Angel investors, banks, anyone that wants to determine how your business is doing, and a lot of times it means that really the business owner needs to be looking at these a lot, and they need to become very familiar with them. And those 3 reports are the balance sheet, the statement of cash flows, and the profit and loss, which is also called an income statement. The first one is the balance sheet. The balance sheet simply shows assets, which would be cash, anything that you can sell. Cash or anything that you can sell for cash is an asset. Or, by way of example, equipment, office equipment, computers, buildings, land, improvements, cars, anything like that lasts for more than like a year is an asset. And it should show up on your balance sheet. The next section would be liabilities, which is money that you owe. Credit cards, business loans, loans from friends that you actually plan to pay back, trade lines, anything like that. So if you don't know, a trade line would be simply if you go to your local warehouse and they open a line of credit for you, you can purchase all you need to for a month, and then you need to pay them back. That's a trade line. That's basically what's on the balance sheet. Now here's where people get confused. We have assets, we have liabilities. The accounting equation is assets minus liabilities equals equity. Could be a little bit different order. Sometimes it's liabilities plus equity equals assets, but it's easier for me to think of it as assets minus liabilities equals equity. So equity confuses a lot of people. Equity, with my clients, if it's money that they are spending personally, but they're using business funds, I will show it as equity being spent. Okay, or I will show it as an owner's draw of some kind. What that's called is going to vary from business to business, depending on how the business is structured. But I'm talking so fast, I'm getting out of breath. But when a business owner is spending money that belongs to the business, but he's spending it on personal items, I've gone on about commingling funds before, and I will go on it again, then we're going to count that as negative equity to the business. In other words, he's taking money out of the business and spending it on himself. By itself, that's not necessarily a bad thing. I just prefer that my clients take that money out of the business and put it in their personal account and spend it from there. It makes much cleaner accounting. So I will have clients that will look at that, and this is over the life of the business. Everything on the balance sheet is over the life of the business. It is as of this date. It is not year to date. It is not month to date. I can't show you a weekly snapshot. It's just, this is where you're at on the balance sheet on this day. These are your assets as of today. These are your liabilities as of today. And this is your equity, what you may have spent, what you may have put in, and what shows up on paper as of today. So that's the first metric. I'm going to look and I'm going to see if your assets are higher than your liabilities, and we want them to be, or at least we want them to be pretty close. I don't want to see liabilities higher than assets. And the reason for that, then you're just underwater. Okay, I might look and see if you buy a car, for example, if you take out a car loan, you buy a $20,000 car, then I would expect to see a $20,000 loan. But I would also expect to see the depreciation on the car kind of match the payoff on the loan. So the worst case scenario I want to see is I want to see liabilities and assets pretty close to equal. But ideally, assets are going to exceed liabilities. There's a couple of reasons for this. One is that if you take out a loan, you're going to put that money in the bank account, which means you now have an asset of cash to offset the liability of the loan. And hopefully you're wisely spending that money. We're going to talk about that in a later video. So I want to see assets greater than liabilities, because that means that there's equity left in the business for the business owner to draw or to retain, and that's called retained earnings. The next report that I'm going to look at is I'm going to look at the profit and loss. I'm going to go back to the balance sheet for a minute. There's two other line items on the balance sheet that I really pay a lot of attention to. One is accounts receivable. That's an asset. Accounts receivable shows up if you have an accrual basis. We're going to talk about bases in a later video. You don't really need to know right this minute. But if you send out an invoice and you record, if you're on an accrual, if you send out an invoice and it takes time for you to be paid, that you're usually on an accrual basis, and that just means that we're recording your income at the time it's earned, not at the time it's paid. So accounts receivable means this is money that you've already earned, that you just haven't gotten the money for yet. It's invoices that you've sent out and you're waiting for people to pay you. Accounts payable is kind of the opposite. It means that you owe other people money, but you haven't paid them yet. Typically, now this is kind of accepted wisdom, you want to get paid quickly and you want to wait as long as possible to pay. The problem, I think, is that everybody tries to do the same thing. So everybody kind of waits as long as possible to pay their bills, and that kind of creates a problem in the cash flow. I'm going to talk about cash flow, accounts receivable, and accounts payable in a later video. But those are two lines that I pay a lot of attention to. If I see a lot of accounts receivable and I see that they are past 90 days, if you've sent out an invoice, it's been 3 months or more since you've been paid, then I'm going to want to talk to you. I'm going to want to talk to my clients that have this going on. If I see that your accounts payable is going on over 90 days, then I also want to talk to you, because it's symptomatic of kind of the same thing. That tells me right there's a problem. So the next report that I look at is the income statement, or profit and loss. QuickBooks calls it a profit and loss. Some other software calls it an income statement. It's really 6 of one and half a dozen of the other. So if you hear it called an income statement and you're used to profit and loss, don't let it rattle you. Oh, excuse me. All this report shows, it shows money coming in and money going out. It's really simple. It's like looking at your checkbook. You really want to make sure that your expenses are less than your income. So some of the things that I look for on the profit and loss, I look at payroll. That's the very first thing. Anything that's labor, contractors, subcontractors, payroll. Payroll is usually a business's largest expense. And so I'm going to want to work with the business owner very closely. And I'm going to want to put them in contact with people that I work with that specialize in payroll, and they specialize in HR. And I do have a partnership with one of the top payroll firms in the nation, because I want to make sure that that number stays within a certain range or percentage range. I also want to look at the advertising budget. A lot of businesses will look at advertising as kind of an optional expense, and it should actually be a fixed expense, just like your rent, just like your utilities. It's something you can't get away from. The reason for that is that advertising is what brings your customers to your door. So you want to spend money on it. It's always great when we can do it on the cheap, but you're going to have to spend money on your advertising somehow. So it's better to select a percentage of your total sales and earmark that for advertising. Just like it's best to say a certain percentage of your revenue is going to go towards labor. Then if you exceed those percentages, then you know how to kind of scale them back, or that you need to kind of scale them back. But this way, you're not scaling them back so far that you're hurting yourself. So that's one of the next thing I look for. I want to see that your income is greater than your expenses. And I'm also going to look at your expenses and see where you're spending your money. And is there anything that I can do to help you? One of the top things, by the way, that I do notice a lot of business owners spending money on that they absolutely should not be is a couple of dollars here and $5 there and $12 here and there. That's basically member straws. Again, I do not like to see commingling with my clients. I want them to take that money out of their business and put it into their personal account, and then their personal expenses stay personal. And in a later video, I'm going to talk about piercing the corporate veil and why that is such a bad thing. I've seen huge businesses, multi-million-dollar businesses, fail because they allowed the corporate veil to be pierced. The third report that I look at is the statement of cash flows. What this tells me, it tells me where the money to run the business is coming from. So much is going to show up as revenue from the business, and hopefully that's where most of the money is coming from. It's also going to show me if you're spending money on your credit cards and if you're taking out business loans. It's not that any of those things are bad, but we want to make sure that we account for them and that we include them in their books so we can give you a proper picture of your business. Now, if I'm seeing that the majority of the funds to run the business are coming from the business, from revenue generating activities, if I look at the income statement and I see that income greatly exceeds expenses, ideally, and I look at the balance sheet and I see that assets are greater than liabilities and that receivables are being handled in a timely fashion and that payables are being handled in a timely fashion, then I can sit down with the business owner and talk to them about how healthy their business is. If I go and I look at the balance sheet and the liabilities are a mess and receivables aren't coming in, and that right there is going to set off alarm bells for me. I'm going to want to talk to that business owner about, look, you are taking out more loans for your business than your business is really worth at this point. Let's go over to the expense report or the expenses and see where we can cut back. Let's see where we can increase your revenue, because I want to see income I want to see income greater than expenses. I want to see assets greater than liabilities. Those are the things that let me know that the business is in good health. And I want to make sure that receivables and payables are being handled in a timely fashion. Now, I can handle all of these for your business. I have a wonderful team surrounding me to take care of all this. So if you would like help with your business and you would like to know where you're at, it doesn't matter what kind of business you have. I specialize in small businesses, 10 employees or less. I like to help up and coming startups figure out how to run their businesses. Feel free to reach out. My contact information is below. You can reach out to me through a direct message, or you can comment below. Hope to talk to you. I will talk to you again soon. Oh gosh, I'm talking so fast. And I will talk to you again soon.